As always, there just seems to be like a lot of headlines, like a lot of market news, a lot of things going on, and then just economic indicators that I think we really are excited to unpack with you today. So I really feel like we should just rip off the band-aid and dive straight into some data. Matt, will you kick this thing off right for
I
us?
will. Thanks, John. Great introduction and welcome everybody. We are so happy to have you as part of our CanderPath family. Again, I look at the names that are included in today's presentation, and just some of these names just put a huge smile on my face. So thank you for spending some time with us today. If you're watching this on replay, welcome as well. We're so happy to have you. As John mentioned, our goal here is to try to take some of those headlines, try to take some of the noise that is out there, and really strip it back so that we can talk with candor. The name of our company, to say things clear, articulate, and it can be completely objective. And so the first thing we're going to start with is our current economic indicators. And we look at about 20 economic indicators each and every quarter as we are trying to determine where our portfolios land, what's happening with our economy, what is the direction we need to be taking with our clients' money. And what you'll see here is a visual representation of those indicators. And they go from everything from monetary policy to economic outlook. And this works like a car speedometer. So right there, we can see there's a lot of yellow. It's sort of our neutral. You'll see a few there that are green, and I'm going to talk about those. And what the good news is there's no real red on here, which is negative. So the other thing that you'll see here is if you look really closely, some of the lines are black and some of them have black and gray. And the gray shows you where we were this last quarter, and the black is where we are at currently right now. So it sort of builds these trends in for us. And again, great graphical representation to talk about some of the areas that we're going to really dive deep on today's call. Let's first talk about what's green and some of the positive. And I'll highlight right there, John, if you have that little mouse pointer you always are able to bring out, is the corporate profit growth. So it's kind of right there in the middle. It is that green indicator. And the corporate profit growth sort of is that reason why, as we look at our market, maybe not last week, but in totality of this year, is we've seen that market continue to rise and we are seeing really, really strong corporate profit growth. And again, that's more of a historical indicator or a backwards looking indicator. And we're going to talk about that in relation to the price to earning ratio, which is a huge metric that we look at. We'll talk about that here in a moment. So that's one of the positive pieces here. I would say where there's an overwhelming negative or the trend is moving backwards is really kind of related to a few areas. And the first one being consumer spending, which is right on top of the corporate profit growth element. And you'll see that the gray bar was sort of towards the green, and now black is pushing back. And corporate consumer spending is a big, big part of our economy. That's us buying things and using our own dollars. Why would consumer spending slowly begin moving backwards? And you'll look at the bottom left and see inflation. And inflation, you kind of work your way over and look at energy costs and look at geopolitical risks. And you'll start to see what the trend is taking place. And I don't think it's anything that you're going to be listening to this right now and saying, Matt, we know we've been going to the gas pump, we've been buying food, we know. But that has a trickle down effect on our economy in that as inflation begins to rise, which is caused by the rise of energy costs, which is caused by geopolitical risks increasing, we start to see where this trend is taking place and something for us to be very mindful as we begin navigating the overall economy and how we're positioning our portfolio. So, again, big overview here is we're looking at about 20 different indicators. We're looking at the trends of those indicators, and then we're taking this information, applying it to our clients' portfolios to see which direction we should be moving. Should we be tightening up on our allocations? Should we be loosening up on our allocations? And where should those dollars, new dollars, be directed right now for our clients?
Yeah, well said, Matt. And I think, I'm going to transition. One of them here is equity market valuations, and I'm going to transition to a slide that I can like almost feel the eye roll of some of you who have seen this slide in almost every meeting we've had together for the last 2 years. But it's an indicator of how important this thing known as the PE ratio is. So Brandon, will you spend a few moments talking to us about how we're kind of interpreting this data at the moment?
Sure, John, and I'm I'm personally not tired of looking at it. I look at this quite often. I'm probably one of those people that, if you've spent time with me, we look at this together. But sticking with the analogy, I think Matt brought up a good point. If we're thinking about like a speedometer, PE stands for price, and then there's a slash there for earnings, and it's a ratio. So if the price of a stock is divided by its earnings, 20 right now is what we're seeing. So that 20.4 is the latest PE ratio. The 30-year average is looking at 17.2%. Now, here's the thing to think about. Just like with a speedometer, if you're on the highway and you're going 100 miles an hour because you have to pass a bunch of traffic or a short blip, now you've started decelerating, but you haven't gotten quite back to the speed limit. Let's say you're still coasting down to about 80 miles an hour or to about 70 miles an hour, and you're currently going about 80. By all means, you are still going pretty darn fast. You're still speeding at a good clip, and you're not quite back down to that 70-mile-an-hour speed limit. And that's kind of what we're seeing right now with these PE ratios, is that we're coming down off of our highs back in January. So John, if you just go back a little bit and highlight that at the top, that cliff there. So we're coming down a little bit. We're having a nice about 20.4% right now. So we're decelerating that PE ratio. Now, how does that happen? How does the price and the earnings reflect? Well, if the price is how much a stock costs, well, there's two ways to do it. Either the price of a stock can come down or earnings can go up. And that's how we see those PE ratios starting to come down. So if we think about where we've been, the large cap stocks really have propelled this. So it's really a collection of 10 companies that have seen that. We've seen that with a lot of tech. We've seen that with a lot of AI lately, kind of looking backwards. And we'll talk about more maybe looking forward what we're seeing. But that's why we have seen kind of this time period where those PE ratios still remain high. They're trending in a little bit more of a, where we like to see them place, but earnings keep coming back very profitable, which is nice. And the stock market has remained at kind of these above 20% PE ratios, at least in the last several months.
Yeah. So Brandon, number one, I think that's a good thing to hear. I suppose it's encouraging to know that they're coming off of their highs. But, if we look at that chart, I think we can all agree that the markets, and in this instance, it's the S&P 500, it still does look overvalued long term if you look at based on that chart. But there's a couple of comments
right.
I think I want to make with that. And it's number one, we're going to discuss in a little bit why that's not necessarily always a bad thing, just something to be very mindful of. And then number two, and I think this is why even more attention is now placed on some of these other indicators that Matt was alluding to a few moments ago. And two in particular we want to talk about. One is inflation, and then the other is why the Federal Reserve's path on what they're going to be doing with interest rates is so top of mind and top of conversation right now.
Yeah, and that sort of leads us into our next conversation. And of course, I get stuck with the most complex one here, which is our inflation component. So it's one of those speedometers we looked at, which you'll remember just going back a moment ago, was sort of ticking backwards. And inflation is really measured in two different ways. Inflation is measured by what you and I as consumers feel, and we call that headline inflation. And then we have the Fed, which is looking at core inflation. And the differences between the two of those is core inflation removes two of the most volatile pieces of inflation. And those two volatile pieces are the two that are right there at the top. One is in green, which is energy, and the second is there purple in food. And so the Fed removes that when they're looking at making economic policy changes because they're so incredibly volatile. Right now, energy prices are impacting all of us. As we go to the pump right now, they are impacting us. But hypothetically, the war in Iran begins to dissolve itself, and who knows which way that's going to go. But even if it doesn't, that's going to have major movements on our energy prices. If that continues, energy prices might continue to go up. If it resolves itself, they go down. The Fed cannot make economic policy on something that could change day over day. And food is very closely related to energy as well, simply because the cost of creating food and delivering food and then us going to get the food, all of it is incorporated there. But there's a few other metrics of inflation that are looked at. Shelter. Shelter is taking a look at rents, and the way they do this is taking a look to see what is current rent on renting an apartment or renting a home. And if you own that home, what could you rent that for? Is making some assumptions there, and the Fed uses that along with core goods, dining, and then auto insurance is used as a metric to determine the cost of actually purchasing a vehicle. And you'll notice that there is a trend still downward in everything but energy and food. So, as we talk about where the Fed ends up going and how they end up changing our interest rates, either to accelerate the economy or decelerate the economy, they're looking at really the core components of CPI, not looking at the headline components, which is what we're feeling at the pump. But as we go back and talk about corporate profits, as we go back and talk about those economic indicators, I mentioned a moment ago, the consumer right now is less dollars are in our pockets because we're spending them at the pump. We're spending it at $4, milk. And so because of that, there's less money that we are spending in other areas of our economy. And that will ultimately end up trickling down. And we'll see where this goes as time progresses. So inflation
Hey,
for us right
Matt,
now is an element we're working. Yep.
yeah, no, that's great. I didn't mean to interrupt. I was trying to let you
Yeah.
flow because you were doing really good there. We got a question come through that I sort of think
Sure.
you kind of answer along the way, which is like, if inflation's lower, why does everything feel so expensive still? And it is interesting, right? Because like you look at this chart, if you go back to like 2022 and see where inflation was, and then watch this trend line down, yet everything does feel so expensive. And what I think that we got this question on the last quarterly one that we did, but I like getting it
Hmm.
again because we acknowledge the fact that like that's kind of the rub with inflation. It's like the rate of change is slowing, but prices don't really tend to go back down from where they were, right?
Also, if we own our home right now, we're not feeling the pinch or we're not feeling what rents are currently right now. So
Mm,
there are elements
right.
to this that we don't feel. I mean, I own a home. I can't say, well, boy, if I rent it right now, the rent is going to be going down. That doesn't change how I spend. John, you and I both just came
Right.
off of vacations. You were driving in North Carolina. I was driving down in the southern part of Florida. In both of those instances, we filled up our vehicle two, if not three times. That's the part that I feel in my pocket right now. And that's the part that is changing my spending habits because more of it's being allocated towards the cost of food or the cost of energy right now, not how much my home theoretically could be rented for. And again, that is just really how the economy and how the Fed is making changes doesn't always seem to make sense to us as the consumer. But at the end of the day, they're doing the best with the information they have available to them in trying to control some of these numbers.
I actually like that example that you just gave because it is a really picture perfect example of how we make adjustments and changes to. So we have got this vacation planned and we've got two small kids. I'm like, do I really want to drive 10 and a half hours? Let's look up flights. Oh, no, we're driving 10 and a half hours because the cost of flights were so absorbently expensive compared to filling up a gas tank, which is also expensive, but filling up a gas tank 3 or 4 times versus the cost of flights was worth it. And I think that's part of what all this is too, is like we make adjustments to rising costs. And so maybe a good transition point here is what we're seeing, or maybe how, as a firm, Canterpath is interpreting what the Fed's going to be doing with interest rates.
Yeah. And let's talk about what this slide actually represents, right? The Fed controls the overnight lending rate to banks, which as that then trickles down through the economy, either accelerates the economy by making the cost to borrow incredibly cheap, or decelerates the economy, slows it down from overheating, and by increasing interest rates. And we kind of see that if you kind of look at some of the trends that have taken place. If you take a look at coming off of coming off of 2000s, right, the dot-com bubble, we can see the trends that took place there and how the Fed either accelerated or decelerated the economy. But look more, start at 2020, right? So 2020, the Fed needing to spur economic growth made interest rates incredibly low. The cost to borrow was incredibly low. We're trying to accelerate coming out of COVID, and we accelerated through fiscal stimulus and through the COVID itself slowly becoming more and more under control, the economy began to overheat, and it overheated in 2022. And that's when the Fed said, we've got to start pulling back. They increased rates. Post 2022, we saw a double-digit economic decline and the thoughts of maybe even going into a recession. So the Fed said we are going to make the cost to borrow really, really inexpensive, and slowly began bringing down rates. And now here we are in 2026, and we're wondering, which way do they go? If you were
Hmm.
present on the early one of our first economic update, we were really kind of baking in two, if not three, declines in interest rates, really helping to pick up steam in in the markets and in the economy. But now, as of late, the numbers are looking a lot more level, if not in some cases predicting a small hike in rates, something that we would have never even dreamed of at the beginning of this year or even at the end of last
Yeah.
year. So what's really fascinating about this is which way these are going to go. And what we have here is in that very light green is where the market believes, as we poll market makers, where do they believe interest rates are going to go? The FOMC is the estimate that the Federal Open Market Committee is kind of giving to us. And then there's a long run projection. So over time still is a lower trend. That doesn't mean that doesn't first tick up and then come down longer term. So this has impacts to our economy. This has impacts to our fixed income and our bonds. This has impacts not directly to our mortgage lending, but again, I think if you're talking about overall movement of rates, that certainly does become part of it. And we will see now with a brand new Fed chairman where his economic policy lands and which way he's going to be moving. So something we're watching incredibly closely and incredibly impactful to our clients.
Yeah, we did get a question on that. And so the question is basically like, when the Fed eventually does something. So I guess let's, in this for context, let's say they raise rates, they lower rates, what have you. What does this mean for my bonds? Which is kind of fun to answer, because I think most of what we end up talking about a lot of times is the markets, like the S&P 500 and stocks. And that's what, like, it's very relatable. Like, we understand that very well, where bonds are totally different. We kind of know what a bond is, but how would you want to answer this question? Because like
Yeah.
for me, I sort of look at and maybe one step further is like, then like, how do we influence the portfolio construction on the fixed income side based on the market conditions that we're in? And before you answer, I will say the one thing I'll mention is, and everyone that's been in a meeting with me has heard me say that the seesaw analogy when it comes to interest rates. So if interest rates go up, bond values go down. If interest rates go down, bond values go up. It kind of exists in the seesaw. And what's very interesting is, just like a seesaw, like the further out you go on that seesaw, like if you're on the very ends of that, you'll really feel that movement more,
John, were
right?
you one of the kids that jumped off of it while you were at the high and then it just came down and smashed your buddy at the bottom? Is that the analogy you're trying to use here?
I'm always reaching for the stars. I would jump off and see if I could slam dunk. I couldn't slam dunk then, and I still can't reach a basketball
Yeah,
hoop.
you,
So,
you brought you brought a good point. Again, what does this represent? As I kind of started this at the very beginning, this represents the Fed controlling the overnight lending to banks. And as I mentioned, I kind of briefly touched over this. This is that trickle down effect. The overnight lending to banks is what the banks charge each other to borrow money. That then trickles down to the consumer. So, as banks are trying to fund themselves, as banks are trying to give loans, as banks are providing interest rates on your money market accounts, if the overnight lending is going down, that has a direct impact on your money market, on your CDs. If you're trying to obtain a mortgage or a home equity line of credit, again, those are using a little bit of a different metric. A lot of that is supply and demand, but still, I'm using the illustrative point that this does control some of the elements, at least the direction of those interest rates when you're trying to borrow money. And so the answer to your question, John, is what does this do? This, as interest rates come down, our bond prices come up, which is a great news
hmm.
because I'm looking at the list of names here, and every single person on this list has anywhere from 10% to 40% of their overall portfolio in fixed income. It's incredibly
Hmm.
impactful. So from a decrease or increase in interest rates, this impacts you one for one. But a lot of our clients also are holding that money market account, that 6 months of fixed expenses, 3 months of fixed expenses, saving up for that big purchase. And the interest rate that you're receiving right now on that has a direct negative impact as interest rates decline, right? The first thing that moves is that money market account goes from, what are we right now, in the mid twos, maybe low threes? Boy, that overnight just drops right down as interest rates move, and there's a direct negative impact to there. So portfolio might rise because bonds might do well if a declining interest rate environment, but then your money market account also earns less interest, which is not the end of the world for most people because we're not holding a lot of our wealth in money market, but every little bit helps, and we love to see money working for you. So that's a negative impact to declining interest rates. But
Yeah.
we're really staying on top of to see which way the Fed ends up going. And again, a new Fed chairperson, we have to get to know personality. Are they dovish?
Yep.
What is the method that they're using to interpret the economy and which way they're going to be proceeding with our Fed funds rate?
Yeah, well said. And I just appreciate the fact that bonds got the spotlight for a little bit on this conversation. But, stocks always steal the show. And that's a good segue and transition to talking about the equity side of the portfolio. Brandon, what do you think?
Well, I think I'm the stock guy then. Is that what you're
Yeah,
saying?
yeah. You get the good part. We gave Matt all the very technical data and
I'm
analysis.
exhausted. I'm going to take off the
Yeah.
rest of the time here and I'm going to relax, let you guys take over the rest.
Oh man. Well, I think that is actually a good segue, because when we think about like what do we, if we've spent this whole time looking backwards and saying, hey, what have we seen so far? And will that continue? And I think the traditional conventional wisdom is it might be similar, but things rhyme, they rarely repeat. So when we're
Hmm.
talking about going into the rest of the year and even into next year, what are some of the headwinds? So what are some of the things that are going to slow us down? And what are some of those tailwinds that are going to kind of propel us? So just like driving your car, if you have a headwind or a tailwind, your efficiency might be different. So going into the rest of the year, some of those tailwinds, things that could really help us out, are if oil prices continue to fall. Now, don't mean to turn this into a geopolitical type of conversation, but it very much impacts the supply of oil. And if the supply side shrinks a little bit, but demand stays where it's at, well, oil gets more expensive. So we're going to be looking at that, and that's a big piece of inflation. So as inflation is trending in the right direction, that looks great. But if it starts to go the other way, I mean, that could be some tightening. AI has done extremely well. We hope that it will continue to do well, especially as companies put so much money into the investment. They are seeing very efficient gains. These bigger companies are turning a profit utilizing some of the investments they have made in AI, productivity, things like that. And with that, if profits continue to do really well and hitting their targets, we're going to see kind of like a nice steady growth for stocks, or at least kind of maintaining those higher PE ratios. We'll see, or maybe they'll stay flat. Profits will go up, and then the PE ratios will come down a little bit, flatten. So those are some things that could work in our favor. Now, it's kind of like the opposite side of a coin here, because the headwinds are just the opposite, right, of what we've talked about. So like oil prices, like other inflationary risks, if things get more expensive, especially if interest rates actually start to go up, well, that could put added pressure on stocks, and it could, help to decrease that. With that, we look at consumer spending and kind of confidence and power, buying power, if you will. Because, if a consumer, if their wages aren't going up, but the rising cost of goods and services go up, well, your dollar doesn't buy as much, right? So that is consumer weakening, and that leads to a lack of confidence, and that's one of the big drivers of stock prices is spending. So it's not just company reinvesting in other companies, it's also consumers buying things and adding to those profitability. So it's both of those things. And with that, AI has been a huge investment. We're going to see coming up if we're sitting on what some people are calling maybe an AI bubble, right? Like I think it's here for the long run, but are we sitting on maybe its acceleration goes down? I think we'll still see spending, but it might not be at the rates we've seen. So we'll see that. But those are all things that we are going to, and we talk about quite a bit when we're talking about portfolio construction. So that's really kind of the next, where we're starting to think about moving into the rest of the year.
Brandon, we have, so I want to go back to the AI thing for a moment, but we actually have two questions that popped up. So I just want to ask these questions to you as it relates to this slide. Or maybe this is just kind of what it spurred for these individuals. But the first one is, and I know who this client is, so I think I know where they're coming from. They're basically saying like, I feel good about like securing like my financial plan. And so this is a retiree, but I'm worried about my young, like my adult children and grandkids. What advice would you give to them?
Hmm. Well, I do hear that a lot. So great question. Hey, you're good. What do your kids look like? You know, how is the best way for them to get ahead? And I would say, um, number one, when was the best time to plant a tree? Probably 20 years ago, right? But when is when is the next best time is today, right? Like we have today. So I would say to that, the longer you invest and the more consistently you do it with quality, the better results you're going to have. And that's just always going to be the case. So I would say when we're uncertain, let's let's add, let's do it well, and let's keep doing it. Stick to that good habit. And I think that's a good way to keep moving forward. And I think we actually have a slide later on that talks about those exact things.
Correct. Yeah, we do. And actually, the second question might be somewhat of a similar answer, although two completely different demographics. I think, the first question was about more of like the next generation, maybe someone that's like in their 20s, early 20s. This question is, given today's economic outlook, how should someone still in their accumulation phase? So, think high wage earner, in maybe our 40s or 50s kind of segment of life. How should someone in their accumulation phase be thinking about their strategy right now? Is this an environment where we should hold steady, or does it make sense to tilt maybe more aggressive or more conservative?
Oh, I want to answer this one so badly. Who gets to answer it? I think we're all chomping at the bit. Boy, I know this client. He's
I
a
got to
great,
read
great.
it, so I want to
He's
answer
a
it. I'll
great
let you.
guy, and it's like he just tossed that softball right up to us, and we're gonna smash this thing
Go
right out
for
of
it.
the park.
Let's go.
Oh,
Here, set it.
I don't
There you
want
go.
to. I well,
Well,
we
just
do.
know we actually specifically talk about different phases of life
Yes,
later,
we
and
do.
we talk about accumulators. So don't give it all away, but
I'm trying
give
not
a piece.
to. Yeah, we have a really great slide that actually graphically shows this. But I would say no matter what the economic conditions are, it is our investment policy statement that actually dictates what we should be doing right now, not necessarily the economy. And I know that might be counterintuitive at the moment right now because we're talking about the economy. The economy shapes should we be at the edge of our IPS or a little bit behind our IPS? And again, IPS is investment policy statement. We have one for each one of our clients. We do not invest blindly and say, "Oh, we should just buy this today." We actually have a very detailed. It's basically a detailed document for each one of our clients on what are the parameters. What can we buy? What can we not buy? And then most importantly, what their allocation is. So to answer this question, the most succinct way is not to time the market. We are not market timers. We believe in building a quality portfolio that is well diversified, and that portfolio must be rebalanced. If we are following those tenets, then we are pretty much able at any point in time to continue with that strategy, no matter what the economic conditions are, because that rebalancing process is going to take care of the economic conditions. If the economy is running and overheating, we are rebalancing backwards, just like we did at the end of last year. The end of 2025, we rebalanced those portfolios. And we're probably getting ready to, well, we were until last week, to rebalance again because we've seen just this huge push in the market. And if the market moves in the other direction, we run into a strong amount of economic headwinds, as Brandon illustrated a moment ago. We are rebalancing in the opposite direction. So I would still say that our strategy does not change based upon the current economic conditions. Our strategy changes when there's a change that happens in your life. And that might become going from an accumulator to our retiree or pre-retiree, in which case we are naturally taking that portfolio and maybe not decreasing equities per se, but changing the mixture of within equities to increase income or to build a large cash buffer. So that's really the way we handle these. Because if we change our strategy every time the market changes, well, even look at this year. which frankly looked very similar to the beginning of last year, where we had economic tariffs. The market had this huge plunge downward.
Hmm.
That didn't stop our strategy. That caused us to rebalance during those periods of time. And that same tenet holds true here today. With all of the economic uncertainties, our strategy doesn't change. It's our rebalancing and what our economic or what our investment mixture is made up of. That's where we focus a lot of our time and attention.
Thanks, Matt. That was a great answer. My strategy changes for the next two slides because I was going to say some of those things, but it's okay. That was a great answer anyway, and I liked hearing you. I liked
You can't
hearing you
let me
say that.
riff. I'm not ever allowed to answer a question again because I
It's
just blow
okay.
the
I'll come
whole
up
Spend
with.
space
too much
open.
time together, guys.
I'm going
That's
to change my
basically-
strategy for the next two
You
slides.
said we had to keep this to
Um,
45 minutes, John. I just knocked like 30 minutes off the presentation.
You did good. I do think that was a good answer, and we'll continue to kind of answer that throughout the rest of our time, the next 10 minutes or so. I do want to acknowledge like the irony that like if you look at this slide, Brandon, so in tailwinds, number 2 is AI as a potential tailwind. And then in headwinds, number 3 is AI as a potential headwind.
Right.
And I think that that's an interesting position that it could go either direction at this point. And I've been getting a lot of questions in regards to, you know, like AI in their portfolio in our investments. I think, you know, one of the things that I want to make sure that we speak to is the importance of diversification. Matt, I think you do a great job, and I definitely want to hear you kind of explain what this is. It's, you know, we call it the periodic table of investments, but it's a chart that shows a year by year analysis of really just the major sectors of the market and how they performed on any given year. But for us,
Go, John.
no, I was just going to say, like, you alluded to one other thing, which is we call it the family investment policy statement. And, you know, I'm going to refer to it as the IPS here on out. But for us, you know, having that IPS that's predicated on your risk profile and preferences, your timeline to retirement, the things that you want to do in retirement, how much you want to spend in retirement, all of this kind of informs this IPS that then helps us with the portfolio construction. But make no mistake about it, it influences the percentages of what we own. But we want to make sure that we own all different segments of the market and not just one. Go ahead, Matt.
Yeah, so this is our Callan chart. And what I really love about this is that from an individual investor perspective, oftentimes we get stuck looking at the trends and take any one of these. So the way to read this chart, and you'll if I meet with you or John or Brandon, we oftentimes bring this up in our meetings. But if you take a look at any one of the columns here, and I'm going to take 2011. If you kind of look at 2011, this ranks the investments by best performing all the way down to worst performing. So REITs stands for real estate, fixed income is our bonds, high yield is our fixed income that has low credit quality. Our large cap stocks, cash, small cap stocks, developed markets is DM, commodities, and then emerging markets is at the bottom. So if we take any one of these and say, wow, REITs did really, really well, I'm going to put all my money there.
Oops.
And you said, boy, that was a great decision the next year. But then you start to see taking any one of these and just putting all of your eggs in a single basket, it proves to be just a really tough way to navigate the markets. And what we strive for is taking bits and pieces of each one of these, blend these in the proper allocation, tailor it specific to our clients, and then allow the underlying investments to perform and rebalance and make sure we are never looking at any one of these and putting all of our eggs in one basket. Because if you've been watching daytime television this past year, all you've been seeing is gold commercials, right? And you think commodities, best performing asset class year to date. Yet if you looked from 2012 all the way, call it through 2020, you went through years of big time double digit negative returns in any one asset class. And so what we want to do is educate our clients on why do we not follow the shiny new toy? Well, we want to make sure that we are not following the trends and potentially setting ourselves up for failure if we're putting all of our eggs in one basket. So I find that this allows me to have a conversation with clients in a graphical representation. Why do we mix all of these together? Why do we have each one of these pieces? And that doesn't mean we don't overweight some of them, underweight, add some, take some out. But all in line, by and large, our portfolios stay relatively intact with small, minute changes depending on the underlying economic conditions, not what did well last year, and we should put that in our portfolio this year. That's a trend we want to make sure we stay away from. This chart shows exactly that.
Yeah, and I obviously we've already alluded to this, but we abide by what we call the family IPS, that investment policy statement. And so but that's just like one half of the piece, right? Like that is critically important. But then I think that this slide does a really great job at illustrating why investing in the market with a long-term perspective matters equally, like just as much. And I would say that kind of back to those questions that was asked a few slides ago, both from like the next gen perspective of someone that's in their early 20s and the accumulator of somebody that's in their 40s and 50s. I think this chart really kind of echoes the importance of staying in the long term. You've probably all heard this quote. It's a very famous one. It's time in the market, not timing the market, that matters the most. And here you can see the dispersion of annual total returns over the last 75 years. So let me just explain this chart for a moment. In the green column, or the green graph bar here, we have stocks, blue is bonds, and then gray is a 60-40 portfolio. And so if we're looking at this one here, this is going back to 1950. This is the range, both negative and positive, to the extreme end that happened on any one given year. So in 1954, the markets were up 52.62% in one single year. In 2008, which a lot of us experienced, this one that's on this call, the markets dropped as much as 37%. But if we take a step back and we just look at any rolling period of time over the last 75 years, so like look at this is the 5-year rolling. So this is any 5-year period of time. You can see that dispersion is much tighter. It's for equities, specifically the S&P 500, it's -2 to +29. And we got to keep going down. Like this is a 10-year rolling, this is a 20-year rolling. And of course, hindsight is 2020. Nobody loves a Monday morning quarterback, but we have such a good sample size of data to point to the fact that staying in the market, coupled with having the right IPS for you or your family, is critically important. Like the marriage of those two things together is really important. And it's why we attach timelines to certain buckets of money. If you need cash in the next 3 years for a home purchase, or down payment for a home or a car or whatever the case may be, we're going to ensure that bucket of money is not invested in the S&P 500 exclusively, where it's going to potentially ride this level of risk and volatility. So hopefully that kind of gives a little perspective on both, not just like the portfolio construction, but then like the timeline of being in the market.
Yeah, I mean, John, I think it's the timeline of being in the market, but also like timing wise, like we can't control timing all the time. That's not something that's possible. So why I love this slide. So this is a slide I've been using for years, but I call this the don't overthink it slide. So what this chart is showing is if you had $10,000 and you have 20 years to invest $10,000 a year. If someone came to me and said, Brandon, I want you in the first perfect timing is I had that crystal ball and said, here's $10,000. Tell me the best day to invest this $10,000 in the stock market. If I would have got that right 20 times in a row, I would have made you right now over $1 million. That's the first one. Now, if we go to the other side, which is bad timing, right? So if you hover over that, now in the same thing, if you were to give me $10,000 and over the next 20 years, $10,000 a year, and I picked the absolute worst time to invest that $10,000, that's represented there. That's $800,000. So it's impossible to have perfect timing. It's just, you can't do it. But by that same logic, it's also impossible to have the worst timing of when to invest money. So what we like to say is, well, just invest, right? So whether we're doing it at the beginning of the year, we're doing dollar cost averaging, we're still coming out ahead, and significantly, right? We're growing that $200,000 over 20 years. Here's what we don't want you to do. Sit on your hands, put that money into that money market account and never invest. Now, I'm not saying don't have an emergency cash fund. This is your extra $10,000. But if you were to just leave that same $200,000 over the last 20 years in cash, you would have $255,000 compared to bad timing, dollar cost averaging, worst timing, or perfect timing. It's a long distance away. So when was the best time to plant a tree? What's the next best time? When should I buy? How should I buy? You know, if your portfolio is constructed, I would say, well, with quality and diversification and appropriate for you, let's just save and let's do it consistently. And that's really, I think, the point of this. And
Yeah, I like
mindset.
that. I like that it's your don't overthink it slide. I think so many folks, whether it's, I mean, your money's the big one, but this comes with like in a lot of decisions in life. Sometimes we overthink things so much that we have what's called analysis paralysis, and then
Mhm.
like we overthink to the point where we do nothing. I think that's what you're kind of illustrating here is like if we're always waiting for the right time or trying to figure out how to get in there, doing nothing is by far the worst of the strategies. So I like that. At this point, what's kind of fun about how we do these conversations is we've got very economic indicators and data that we go through. Then we kind of talk like market and portfolio construction and what we're looking at. And then, what we really have started to do, we've only done this one other time, but I enjoyed when Matt did this. And it was kind of outlining, okay, so then, with some of this stuff, what are some actionable takeaways? And with everyone that's on this call, we have such an age range of different folks joining us that are in different phases of their life. And so we really want to kind of give a handful of maybe just like one or two for each situation and phase of life that you're in, takeaways from today's conversation. So first up would be the accumulator phase in life, Brandon.
Yeah. So accumulators. So
You're
if
speaking directly to the client that asked the question.
I am, and I guess I'm the stock guy too. So this is a good segue really into that is, so if you have access to a 401k, I would highly recommend that you utilize that 401k to its fullest. And if you have money deducted out of your paycheck each and every month, you are dollar cost averaging into the stock market. So I would say number one is make sure you're properly invested. We help clients with that all the time, but here's some of the big things. Just make sure you're not investing in just over concentrated positions. You're not all in the small cap space. You're not all 100% in the large cap space or bonds or whatever it is. Make sure it's appropriate and you have a well diversified portfolio. Or if you have the option to buy individual securities, just make sure you don't have only 10 of them. And the other one is make sure you're capturing all of what you can. So if you're just starting out, definitely get your match. So if your employer offers, let's say, a 3% match, but you have to put in 6%, do 6%. That's going to be advice I always give you. Don't leave money on the table, always. The other thing, too, is the limits go up every year for how much you could put into a 401k. So if you do have the ability to put more in, we highly recommend it. It's $24,500 in 2026, and it went up $500 from last year, and it's probably going to go up another percentage by in 2027, and that has gone up every single year, at least since I've been in the industry. So I'd say for accumulators, that's probably the best thing is add, save, and keep doing it.
Yeah, and speaking to what Matt talked about with the IPS before, where we've got kind of low ranges and high ranges of how we can adjust to that, know that that's like a big factor of consideration for diversification, both in the 401k, but keeping in mind that IPS. And I like the point that you made, Brandon, about the contribution limits. We audit that every year for clients that are in this accumulation phase of life because it does change every year. Even if it's by like $500, like no stone left unturned. Like let's make sure that we're getting the most that we can out of these funding vehicles. Transitioning to what we define as a pre-retiree. So that might be somebody that's, let's say, 3 years away from retirement. They're really starting to think about this. And this is a big deal because this is a really large life transition. The idea that we're going from all these years of saving and accumulating and building for tomorrow, and then like that day's coming. And now we're going to switch to, oh, I'm no longer earning money and adding to, I'm actually turning on some of these buckets of money and spending. And so one of the things that we talk about is starting to think about, this is beyond your emergency bucket. Of course, we all know 3 to 6 months of expenses in your emergency bucket, but really starting to think about what those near-term spending needs, let's say like maybe in the next year, what your budget will look like. So we can start to sort of compartmentalize some of those dollars to be there to insulate you from market volatility. And then also, and folks that are on this call, we've done this together. Brandon's, a master expert at this too, is the stress testing not only the asset allocation, but the financial plan itself. We really try to stress test. We add additional inflation. We reduce the cost of living adjustments that Social Security gets. We reduce returns on the portfolio. We really stress test your financial plan to make sure that, like, okay, if these 17 factors go wrong, but there's still a potential positive outcome for your financial plan and your investable assets over the course of your retirement life, that one's a big deal. So those are the two that I would say for pre-retirees. And then retirees. So now we've transitioned, we're in retirement. This one's a big one. I don't want to just flat out say, like, let's fact check the budget, but let's do that sometimes. Like, we want to make sure that your distribution strategy today is not based on last year's budget. Like, as we talked about with inflation, things are still expensive. And so we want to make sure that we're matching those two things. And then, of course, what I just talked about a moment ago with pre-retirees, that bucket strategy, that for all of our clients, we really ensure that, that whether it's that bond sleeve or cash in the portfolio or short-term bonds, that we're insulating money over the next maybe 1, 2, or even 3 years from market volatility, so that you have this peace of mind of knowing, like, yes, volatility is going on today, but that's part of my portfolio that, like, I'm really not going to reach for until another 3 or 5 years from now. So if I can afford that time in the market, I can let the markets do its thing. And then last but not least, Matt, would you touch on next
finally
generation,
again, an
please?
easy one, John. Yes, thank you. And this goes all for the grandmas, the grandpas, the pop-ups, the mimis out there looking at that next generation. You're trying to set those grandkids up for success, or maybe it is your own kids you're trying to set up for success. Being able to give the gift of financial stewardship is so incredibly important. I got to give a lot of credit to John, who's come up with our e-course, which is a very easy way for you to introduce your kids, your grandkids to the basic tenets of financial planning through a video interactive process. So I would say that's not one of our check boxes there, but please know we have so many resources that are not a sales that you got to go work with CandorPath, you got to go work with Matt, John, or Brandon, but that gives you the tools to be able to, in a very objective, clear, concise way, share the gift of financial stewardship with your family. Please consider using our e-course, which again, we'll set you up with. Just shoot us a quick message. We'll get you signed up for it. It's so incredibly easy. And for our clients who are trying to set those kids up for success, or those grandkids, obviously encouraging them to participate in their retirement plans if they're starting their first job. And this is for your grandkids. Remember, getting them those toys for birthdays and Christmases really it puts you high up on the list, but really helping to fund future college education is so incredibly important. Adding a little bit to the 529 plan, there's some really great elements that have changed in tax law for the 529 plan, which allows you to use unused dollars to set them up for a Roth IRA in future years. So there's so many fun things that you can do to give the gift of financial stewardship. We want to encourage you. We have all of those tools here available. We just need you to use them and be that objective voice of reason for your family as well. So again, we love all you guys. We're so happy you joined us here, and those are just a few additional points we want to make sure you're all aware of for this webinar.
Yeah, I appreciate you saying that, Matt, and Brandon. Great job with us today too. Like, this is always, it's fun for us to come on here and talk with our clients in between the review meetings about these types of things. As Matt alluded to, yourmoneystory.app. That is great. Like, it's for financial stewardship and for folks that really need that, like, base level of planning. It's a great one. It gives them the budgeting tools and the apps and all that stuff. But I do want to call out, as we're wrapping up, one final piece: www.candorpathclients.com. Megan was actually the one that was just instrumental in going, we have a portal problem, because every financial planning firm does. It's like, we've got a tax portal and we've got a client online portal, and there's a vault to upload things to. And so, how do we schedule a meeting? And we really wanted to make that easy for you. So friends, please bookmark CandorPathClients.com. Inside of there, it's just quick links. It's meant to be like a simple cheat sheet for you of, okay, I need to schedule with Brandon or John or Matt. I need a tax planning call. I want to upload my tax stuff to the tax portal. And so CanterPathClients.com, bookmark that. And then, of course, a shout out to the Above Board podcast, which Matt, Rich, and I love doing every week. Well, as we try to. We haven't in the last month, but we're going to get back to it. Right, Matt?
It's on my list. It's on my list of things to do. That list is very long.
Brandon was the last team member to be on the podcast. So we'll have to have you back on, buddy.
He's always trying to one-up me, Brandon.
Okay, I'll probably be the next team member on too.
I love it. I love
Just
it. Well,
kidding.
friends, thanks so much for joining us today. As I said, we love doing these. Any feedback, feel free to send me a message and let me know how we can make these better, how we can add more value to them. But we'll continue to do these every month. So the quarterly economic and market updates, those are done on the quarter. But we're going to continue doing these each month. In the next few months, we got a Medicare one coming up and some fun other ones. Raina will send out an email with all the months ahead. So thank you guys for hanging with us today here at CanterPath, and we will talk to you soon.